Hi, everybody. This is Paul Cooper with Totes and Notes, and I'm bringing you this week's Market Meltdown. So, the first topic I wanted to discuss here was the courts finally approved Wells Fargo $142 million fake account class action settlement. If you haven't been following this, Wells Fargo was just awful. They were making fake accounts for people just to create fees, doing all kinds of stuff. People would close out, and then years later they would have these accounts open in their name that they never opened. I actually had some family members that were victims of this, so it's a pretty big deal. Looks like so it's $142 million right now. But the big thing is that the judges made them they have to agree to cover anyone who has been wronged by this and any type of damages to them, whether it's to their credit score, to their good name, things like that. And the money's actually going to the victims as opposed to just being a fine going to the U.S. government, which is good. So hopefully this is the right track. Hopefully we'll stop preventing this. But really, $142 million is a drop in the bucket to Wells Fargo. And here's the other deal: people have got to prove that they actually had damages against them, which will be hard because now otherwise you're expecting Wells Fargo, the criminal, to come forward like, oh yeah, we wronged these people and they didn't know it and help them. That's not going to happen. So, if you ever had an account with Wells Fargo, you may want to look into this because they may owe you some money for some damages. Then I saw this interesting article. It's talking about multifamily and how it's just incredible. They've got a really high rise and march on the upswing due to demographics, economic situations, everything like that. You know, a lot of these major cities are building like crazy. Denver, fastest growing metro in America, has been building multifamily apartments and everything like that like crazy for years. And here's the deal: they're getting to the point where they're going to have more stuff coming online than meets demand. So some cities it's still a good idea, but I think most people, if you've been following rentals and multifamily for a while, that they're really getting overbuilt. And you need to be careful with that. You don't want to end up going into something and get caught with your pants down there, and things swing down and you owe a bunch of money. That being said, I've got to imagine most of you watching this would be buying used stuff or already pre-built stuff as opposed to building brand new. But just don't get taken for a ride, people. Always make sure that you're buying at a good price in case what hits the fan. I thought this article's title was interesting. First American: Lenders Shouldn't Worry About Rising Interest Rates. Apparently, demand's so high in a lot of parts of the U.S. that we really don't have to worry about the interest rate increasing because demand's so high. I don't like this article. I disagree with it. I think it's a stupid statement because here's the deal. Things have actually been slowing down universally. You have hot markets like Denver, like Colorado Springs, places on the West Coast and the East Coast. But if you look at Middle America and your average cities, things are slowing down. The markets are not nearly as hot, and the rates are actually negatively affecting that. Because when rates rise, it does make a big impact on how much home you can purchase. I forget the formula, but it's pretty significant. Like I think each quarter percent that a home rise affects your buying power by about $10,000. That could be completely wrong, but it's not a minor influence. It's pretty major. So unless people are already bringing a lot of money to the table or just resign themselves to the fact that they live in a super expensive market and are always going to pay a ton of money for housing, you start getting to more normal America. These interest rates are going to have a huge impact, and I think they've already increased a couple times, and this article was saying that they're expected to increase 2 more times before the year's over. So we'll see how that affects things. All right, then here's more of a global view. We're looking at China and the trade trap and the trade wars that we're getting involved with here. And it's not just with China. China's the big one at the moment, but we're doing it with Europe. We're doing it with the rest of the world, and it's not good when you try. If the only way you can compete is if someone else is making something better than you for a cheaper price, and the only way you can compete is by basically penalizing them to where they can't compete in your market because you've increased their rates, then you don't really have a strong economy. So you need to figure out what you're good at and go with that. So it'll be interesting to see how these trade wars play out. The Trump tax plan has had an overall positive effect on the economy for the most part. It'll be interesting to see if this kind of cancels it out or how it affects it at all. So keep an eye out for that, and that's more of a global deal. Shouldn't be affecting what we do in our housing markets in a big way, but it could stunt the GDP. We'll have to wait and see. And then here I got some more doom and gloom for you. Paul Tudor Jones, the next recession will be frightening. I like to be cautious, and I'm probably more bearish by nature than I am bullish. But at the same time, when you're constantly fear mongering, it gets a little old. But there are some interesting parts in here. If you follow central bank and things, what they're doing for our asset prices and things like that, it's, the last financial crisis, we really didn't resolve anything. We just inflated it back up. So it is kind of correct that the next recession will be frightening because it's going to be really hard to do the same thing again. So just keep an eye out that. And this is more of just a cautionary thing. Just, guys, don't invest in things you don't understand. Worst comes to worst, if you keep money in the bank, yeah, you're losing a little bit for opportunity cost and for inflation. But you know what? If you don't put it in something risky, you're not going to lose it. So, just be cautious with things going on. When you start reading a bunch of articles about, oh, this is the next hot thing, like cryptocurrency, Bitcoin, things like that, it's probably too late. You're probably missing it. And then been a lot of articles lately about getting back into precious metals, gold miners doing stuff like that. I actually owned a lot of precious metals and a lot of junior gold miners. I already sold out. I've made my money. They're probably going to go up some more, but I was happy with my 60% and I moved on. So it's one of those things, when people start talking about precious metals and stuff again, that's usually when you should start analyzing to see what the market is. What are the bonds doing? What are the stocks doing? What's housing doing? Because usually when people start talking about precious metals and moving into it, it's generally a kind of a fear play. You're hedging your bets against the stock market and everything else because you think it could possibly go down. And precious metals are historically seen as a safer investment. And talk briefly about minimum wage. What people believe. This is a very stratifying topic. I'm on one end where I don't like the increase in minimum wage economically, and then I've got family members that are the complete other end that minimum wage hasn't been been keeping up with costs, and I agree it hasn't been. But when you peg the minimum wage to something, you try to increase it to force stuff, all it does is pass those expenses along to other customers and everything. So you're really not getting ahead. And this article had a pretty interesting point about that if someone's making $10 an hour and then they're getting health coverage or other benefits to their job, their effective wage may be $14 an hour, and then or it could even be higher, $16 an hour for those benefits. And then if you increase the minimum wage to 15 or whatever, then what you're doing is they're getting paid that money now, but they're losing out on their benefits. So overall, they could be they could either be the same or they could be worse off. And so it's kind of an interesting, they had a nice little video here, and it was just an interesting concept to think about as opposed to one of those really polarizing articles where it's just screaming, you're either for or against it and things like that. So I'll make sure to put all these links up in the YouTube description below, so if you want to read more, you can. But I just thought this article was well done, and it didn't have all the rhetoric that a lot of articles will. Then for our last article here, we're talking about credit card debt and how we're just getting to a point where instead of increasing credit card debt, people are slowing down on their spending and they're actually paying for some of it. And you're like, oh, that's good and everything. It is, but it usually signals a downturn in spending in the economy. And this is the highest it's been since, I believe, 2007, 2008. And so when people stop spending, they start paying down debt. It is a prudent and smart thing to do, but it usually slows down the economy a little bit because people aren't going out and buying Starbucks and just all the other material junk that they don't need. So it'll be interesting to see what happens here in the next quarter and the rest of the year. Things look like they're starting to slow down. But that's all we have today, and if you have any questions or comments or any suggestions on topics you'd like me to cover, please reach out to me. And thanks for your time.